Welcome, everyone, and thank you all for joining us once again for our monthly webinar series, where we bring in industry experts to give us insights and wisdom on various topics related to real estate investing. My name is Sohail Hassan, and I am the managing partner at MarketSpace Capital, a private equity real estate development company headquartered out of Houston, Texas. We currently have 19 investments throughout the United States across various asset classes, including retail shopping centers, office buildings, and of course, our primary focus, the acquisition and development of multifamily apartment complexes. Our current assets under management, upon some recent closings and partnerships, is now right above $400 million of AUM. And I'm, of course, joined by my fellow co-host and the Honorable Chairman of MarketSpace Capital, Dr. Masaki Oishi, affectionately known to all of us, of course, as Mas. Welcome.
Thank you, Sohail. And it's my pleasure to be here with you to discuss such fascinating topics and something we ourselves have discussed as really being a big part of the future of MarketSpace Capital. And that is, of course, opportunities for overseas investors to access the United States real estate market.
Absolutely, Mas. And I am so excited for this webinar for two reasons. First and foremost, the United States multifamily market presents a phenomenal opportunity for foreign investment firms to deploy capital into stable assets. And secondly, I'm extremely honored to introduce our partners for whom we have just signed a joint investment agreement to deploy $150 million over the next 3 years into multifamily real estate assets in the United States. Please welcome Finsa and Upper Growth Alternative Investments.
So this is very exciting news. It looks like we have representatives from Peru and Chile. Why we've been boiling in Houston for the last 2 months now. You guys have been having freezing temperatures. So from my understanding, it sounds like Finsa and Upper Growth Alternative Investments both have a tremendous track record when it comes to producing returns for investors through a variety of asset classes. But now in a topic which I hope we will explore a little more in detail later in the webinar, the political and economic environment has changed over the last couple of years, especially since the onset of the pandemic.
Yeah, that's exactly right, Mas. And contrary to instability, I think the United States multifamily market has never been hotter, right? Especially since the start of the pandemic. Since its inception, demand for retail and office space has obviously taken a substantial decline, but the multifamily sector, which MarketSpace Capital has made its primary focus since 2018, has never presented more of an opportunity. And to further add fuel to this fire, population and business trends are overwhelmingly favoring the very markets that are local to MarketSpace Capital, that being, of course, Houston and Dallas. And as you may have read in the news, all of the people that are leaving California, Chicago, and New York, the exodus of those people, the biggest beneficiary to that exodus has been the state of Texas.
Yeah, absolutely, Sahel. And it's funny you brought up commercial real estate markets taking a bit of a hit. Well, I've been in the real estate business since I was a teenager, helping my parents manage properties. And, I've seen firsthand the evolution of how technology and also the pandemic fast tracking the process has allowed more and more people to work efficiently from home. So not only is the United States multifamily market presenting a great opportunity for investors around the world, I'm seeing some of the best opportunities today since having been introduced to the real estate many years ago. I know I look like I might be in my 20s, but I've actually been in the game for a few decades now.
No, definitely, Mas. And that's why we're so excited to hear how foreign investors can access the U.S. market and partner with us in our investments, which include everything from value-add investments to ground-up and mixed-use developments. So without further ado, I'd like to welcome our friends. And I really say friends. They're more than our partners. They become our good friends. I'd like to welcome Gonzalo Colucci, the partner and head of strategy at Upper Growth Alternative Investments, as well as Juan Eduardo Biel. He's the partner at FINSA. Gentlemen, welcome.
Thank you very much, Sahel and Dr. Oshishi. And we're very pleased to be with you this evening, and very proud of this new adventure that we're doing with you guys on the real estate market in Houston and in Texas.
Thank you as well, Mas, Sohail. It's a total pleasure to be here. Thank you to all the incredible market space team. And as you said before, we are friends. We work as friends, as a common team now, and that's super exciting to us. So I'm Gonzalo. I am one of the partners at Upper Growth, and more importantly, I'm one of the partners with Juan at FINSA Upper, which is a joint venture we recently created to channel mainly Latin American funds into the growing US real estate market. So just a brief intro about ourselves. As opposed to Mas, I am actually 20, but this is what Latin America does to you, right? No. So we're alternative investments guys, and we have done that for the last 15 years. I would say 10 years consistently in Latin America. Before that, we were mainly investment bankers. We have developed pretty large private equity and real estate type of investment platforms in the region. But presently, and for the last almost 3 years, we have been concentrating on efforts on how to build up something different to offer to our investors in LATAM as a way to go into a more developed market. And we believe that the relationships, who you do it, and we're going to talk about that later on, is everything. So we're thrilled to be with FINSA and you guys developing this platform.
Thank you.
So, Juan, maybe you can.
Yeah, I can tell you a little bit about FINSA. FINSA is a financial boutique that was established many years ago, and one of the founders is still with us in the company. We do different business, mainly in Chile, and we have some things in Peru also. We manage around 1.2 billion in the wealth management area. We have an asset management team who has been involved in different asset class, like the real estate, mainly in Chile, some infrastructure deals in Chile also regarding energy, private debt, and also we have an M&A area, and we are very active in the trading business in the local fixed income. So we have a big track record on not only in our as the company, also in the people who is working in the company right now. And we decided some years ago to start investigating and researching the real estate market in the States, just to do something there. And in that sense, we decided to do this JV with Upper Growth, to join forces, to join capabilities, and get to new partners in the States to develop this new platform.
So we thought it would be good to actually tell you a bit about our main core philosophical points, anchors that we have, and how we see this platform and actually everything we do. So we have like 3 core conditions in order to do something. We want to be sure that we're doing that with the right people. So who do we work with in the States? We work with a very small, robust set of relationships. We believe we can manage no more than 5 relationships. Presently, we have 3. They are all, and we ask them all to be experts in a certain industry, asset class within real estate, and or experts in a very specific geographical area. Some guys are more like developers, others are more more asset managers, I would say. Others are perhaps the smartest guys in town and are very concentrated on a very specific community, as our friends at MarketSpace. Where do we go? We go to what we define as high opportunity niches. Communities, neighborhoods, areas that are changing dramatically, that do look differently compared to what they were, I don't know, 5 years ago, but much more, we believe they're going to look much more differently in the next 10 years. So we want to be there, we always say, before the Apple Store arrives. And we want to do something that is transformational. And we're open to analyzing both upscale parts of the cities and lower income areas that are going through gentrification processes. So when we do something in the upscale kind of sector, we try to we normally go for the cheapest, for the basic model. So if it's a car, we go with the one without sunroof, or if it's an iPhone, we probably get the mini, because we believe that's where the wave carries you forward. So you just follow the wave, and the fundamentals are there, not necessarily by what you do, but by being part of a larger process. And on the opposite, when we go into lower income segments, we try to do something that is dominant, large pieces of land that we can actually transform, and where we can propose something different, and where there's space and time to capture the value that we generate in time. And that's exactly one of the examples where investing with MarketSpace in a very dominant is the word, I believe, area in Houston. So that's where, and it's basically Sunbelt. We also like the Great Plains. We believe it's actually not just a horizontal line, but it's rather across. We like Denver. We like Colorado. We like other places up north. But if you ask us, I would say that maybe 80% of what we will be doing is concentrated in Texas and Florida, and in Texas especially in what we call the Texaplex, which now we don't call it, what people define as the Texaplex. Maybe Juan, you can tell.
Yeah, basically, if you look at the last U.S. Census, you would see that in the last 10 years, the state that have received more migrants or more migration is Texas. They receive around 2,000 people per day. It has grown more than 15% in the last 10 years, and is nowadays the ninth largest economy if you define it only as a country, if you compare it to the other countries. So basically what it tells is that there are a lot of opportunities, there's a lot of businesses moving there, and where is jobs, people needs a place to live, and that's basically why we like Texas and what is going on that state. And the Texaplex is basically where most of the people that live in that state lives. It's around 80% of the people that lives there. So basically that's the more interesting triangle to be looking for real estate deals.
And finally, how we believe that it's all about having a programmatic approach. So with each manager we work with, we try to define a very specific strategy that is scalable, that is relevant to our investors and to the manager. And we normally want to be partners. So we are not passive investors. We normally don't play as LPs. We rather are co-GPs. We bring LP money, but we try to participate always on the passenger seat, not on the back seat, not driving, but on the passenger seat. We let the local guys lead, and we try to validate major decisions and try to add some value to have certain initiative, but we want to be there and work as one team. So we believe that's a differential to our investors. We are not the guys allocating money to a plethora of players all across the US. We want to be the guys that have 4 or 5 investment programs that are consistent and are cost efficient, because we normally send back to our investors a big proportion of whatever agreement we have with our local partners, and we believe that's a differential. Maybe we don't have the largest radar, but we have a very well focused microscope, and by targeting that, we are able to provide consistent returns at a better fee, under a better fee scheme. So how we normally develop sub strategies within the scope of what the manager is already doing. So let's say we have a manager who's doing, I don't know, multifamily. We normally say, okay, let's focus on this area, or let's try to do, I don't know, bridge to perm, or only value add, but this type of value add. So for example, Market Space is doing a lot of repositioning. That's the kind of value add that we like. We think it shouldn't be about dropping a bomb and changing everything. It should be about looking at an asset and a community with different eyes. So we have to believe ourselves that we can do better, that we can bring better people who's actually going somewhere. So that's the kind of approach.
Yeah, I think Gonzalo, as you were telling, this is this JV is a platform. Our first strategy is to do value add with the local partners, but it's a flexible platform that will look, as Gonzalo was telling, to other strategies in the real estate market. So in that sense, if there is opportunities on the developing or in the repositioning, we will be doing that, or we will be showing that to different investors in this new platform. It's very flexible in that sense.
Yeah, and finally, we come up with what we call tactical adaptations. So we try to make the holding periods shorter, or we want to maybe play with some extra leverage, always very conservatively, but stuff like that, just to add some flavor to the strategy. So that's what we define as revised strategies, sub-strategies that we come up with our local partners. There was a slide, actually, I don't know if we took it out, that was pretty much about what's going on in Latin America. So that's it's not a horror movie, but it's close to it. Yeah, but again, we believe that people can be, and that's of course a big differential that human race has. People can be aligned behind a good idea. And presently, we believe that US, Texas, and working with you guys, it's a great idea. So we try to be seen as well-connected professionals in the region, and we try to present Latin America as a viable, trustworthy investor. We're 400 million people. We have a larger GDP than India. So that's something. The thing is that we are spread out in how many countries? I never remember, 19. So that's what we're trying to do. We're creating the network to have an investment corridor that goes consistently into the US. Of course, we're not going to abandon our Latin American efforts. but we believe there's a big play in the US. This is the third migration wave, and it's heading towards Texas and Florida and Arizona and Alabama. So we want to be a part of that. So yeah, we have inflation, we have a lack of political leadership, so many issues. But again, there are smart, sophisticated investors. Alternative investments in Latin America are consistently growing, and our investors are learning about that. I remember making some calculations like 5 years ago, and only 2% of the total holdings of the total pension fund system in Latin America, from Mexican Afores down to Chilean AFPs, pension funds, that added up to only 2% of their holdings, alternative investments. And within that, you would have private equity, real estate, and hedge funds, and infrastructure, of course. And if you look at, I think we made the calculation comparing with CalPERS and HMC, one big pension fund in the US and one big endowment. And they were investing up to 50% of their holdings in real estate, in alternative investments. And I think real estate was the largest proportion, like 30-40% out of that. That is really changing. So I got to do the math. I guess Latin America is with, I don't know, at a 3-4% level right now, but it's growing. So there's an audience now you can talk to. Institutionals, most of the pension funds cannot invest abroad, or in some countries they can. Mexicans can, Colombians can, Peruvians can, Chileans can. The rest of the markets are more complicated, and we have other type of complications. For example, in Argentina, where we do stuff and know quite well the local capital market, it's really hard for you to set up a structure to go and invest abroad, at least at a public level. I mean, presently you cannot even buy US dollars, right? Unless you go to a parallel market. So there are challenges. Chile is a dream. It has always been a dream. So many solutions, so many sophisticated investors, but it's presently going through some turmoil. Colombia as well, Peru as well. So again, we believe this is a good opportunity, and these are good ideas.
Well, Gonzalo and Juan, I just wanted to follow up by saying, we have, it has not escaped our notice that the states that are doing quiet entry, like Texas and Florida, have very strong ties to Latin America. And I think that's a big reason why those states are seeing great economic stability.
Yeah, absolutely. And as Gonzalo was saying before, we're through some changes and challenges in these countries. I think there will be opportunities either way in Latin America. But I think nowadays, in terms of growing, in seeing opportunities in this asset class, the states show us and shows everyone better opportunities. Is a deeper market, is the biggest real estate market in the world. It has a better institutionality in terms that things doesn't change or don't change every day, and you have a better stability in terms of political issues also. So in that sense, you have big companies growing, giving new employments, and that's opportunity today. And that's the reason I want to how does it is in English, to focus on the growing opportunities in the States more than in the instability, political things in South America.
Because you don't know when it stops, right? And you can dream your life away here in Latam. Like, you can have really long periods where you cannot do much. And the States, they may be, even in the real estate sector, you may have a 1 year stop, normally because financing stops, right? But then financing comes back and you have a M&A activity and development and everything. In Latam, our frozen periods are much longer, and we feel comfortable. We learned that we're comfortable. The US is not that, how to say it, it's not that Anglo-Saxon, it's not that Germanic in a way. It's very Latin, it's very cosmopolitan. There's people from all over the world, and we feel at home. Not only from a cultural perspective, but also in the way people treat you. You can create good relationships, and we believe there's value. I mean, you have to invest time into that, and we're doing it consistently. And I believe that's the key takeaway from this experience is that we can do well in the States if you invest the time and meet the right people and you filter and you're convinced on what you're doing. So that's the idea. So I don't know. With respect to the market, we believe it's amazing what's going on. Personally, I have certain considerations about certain markets that perhaps have grown too much or too fast. So there will be winners and losers and corrections, but there are genuinely growing markets, and that's where we want to focus. And we want to attend the workforce segment. We want to talk to the millennial blue collars, those guys that are entering certain markets, starting to access their first home, their first decent rental place, their first car. So that's where we're trying to focus with you guys.
Yeah, no, absolutely, Gonzalo. Thank you for your comments and your feedback. And I think as you mentioned, these take time, right? It takes time for you to properly vet from your end, and be introduced to a partner like Market Space Capital, to vet them properly as you have over the last year, to come and visit us in person to see our properties, our operations. So of course, all of these take time, and we understand the legwork that goes into this process. But fundamentally, we believe that the multifamily real estate asset class in the United States is perhaps the best asset class to invest in right now. As we see that there continues to be high rental demands across the market, and due to the pandemic, it essentially, increased the idea that people aren't able to purchase their own homes, and therefore they're more likely to rent. So the pool of renters has expanded significantly in the United States, and even millennials are choosing not to buy their own homes as they graduate from college and get their jobs. The idea in the past has always been to be more along the lines of purchasing a home and settling down with your family. We're seeing clearly that that's no longer the case, and that obviously benefits the multifamily real estate market. And these investments, of course, have significant cash flow. For your listeners and for our listeners who aren't familiar with how these investments work, as we invest into these assets, there are two main ways that we are able to generate value for our investors. And one of those main ways is, of course, through cash flows, right? As we are collecting rents every month, we're paying off the expenses, the maintenance, the operations, but everything left over is essentially being distributed to our partners. So therefore, these types of investments offer long-term cash flow. Third, of course, are the significant tax advantages that are associated with these investments. For every single one of these investments, we conduct what is known as a detailed cost segregation study. And that basically allows us to break down the different components of the project into different tax depreciation categories. For example, toilet or lighting fixtures or flooring, these might go into a 5, 7, or 15-year category. But what that allows us to do is to be able to take those depreciation, or a majority of those depreciation, in the first year alone, which of course allows for significant tax advantages. Additionally, we see that this is a scalable market. There are, our pipeline at Market Space Capital, we do 6 to 8 investments every single year. And we have the ability to scale to different states as well as different geographic markets in order to diversify our risk in our investment portfolio. And finally, real estate is very different from stocks, right? There's a certain inherent volatility that comes with the stock market that, as you see, is dependent upon the political situation. Um, Real estate is very different. It's a real tangible asset that you can touch and feel, and therefore it does not go along with the normal volatility that might be inherent in the economy. So for these reasons, we see the multifamily asset class in the United States as the best investment vehicle, and that's the reason why we, Market Space Capital, in 2018 started shifting our focus to this and making this our primary primary goal in acquiring and developing new multifamily real estate assets.
Sohail, I would add one thing that it also appears in one of the slides before. We were talking, or there was the inflation rate in South America, but also in the States nowadays we have a 12-month inflation rate of is 4.5 or something like that, and the real estate asset class usually can catch up on that. On the inflation rate, you get that value. You go increasing the rents on also in the inflation rate. Isn't that right?
That's exactly right. Thank you for
I think
pointing
it's
that out. Yeah.
No,
Go
I
ahead,
think it's a
Jason.
great edge vis-a-vis inflation. Secondly, it offers amazingly low obsolescence. So a 30-year-old residential building, if you keep it right, if you maintain it, if you tell a story, if you take care of it, it can be still a prime asset. An office building, 30 years old, man, you better do some capex there. The same with a shopping center, right? So lower obsolescence. It's a greatly defensive asset in context of inflation. Of economic distress. We already said it's a great hedge against inflation. But when there's distress, especially in countries as ours in Latin America, where the GDP really goes down several points, it's really protective because people normally postpone any property buying ideas they would have, and they just keep on renting. So that's also amazing. And finally, diversification. You have 300 tenants in a building. If you have a shopping center and Costco lives, or any big anchor you have there, H&M, that's a big issue. In a multifamily for rent building, if the previous lady in the building leaves, it's a real shame, but the asset is as good as before. So we love multifamily for rent.
Absolutely. Thank you. And specifically, we focus on our value add side of the business, which is structured very differently than a ground up development program. But typically these are existing assets which are in a fantastic location, but the asset has been mismanaged or neglected. And most importantly, the rents are below market. So we see an opportunity to acquire and reposition the asset to create value for our investors. And basically, since these assets have some existing cash flow in place, it means that the investment has been de-risked to a certain extent. And when we acquire these assets, we seek to immediately implement our business model, which is to cut the fat and to reduce operating expenses. And as the units become available, we implement a comprehensive renovation program where we install new flooring, new granite countertops, new lighting fixtures, the works. These newly renovated units get put back out onto the market, and we increase those rents right by an average of right around under 20%. So the goal is that we can reduce operating expenses significantly and then increase the rents on those renovated units, and thereby creating value not only for our investors but also for the community. And when we get these investments, we get a loan not only to acquire the asset, but also to renovate it as well. So it's not like we're paying for the renovations from the cash flow that we're collecting. What this means is that all of that existing cash flow is being collected and essentially stored into a reserve account. And obviously, it's important to keep a good reserve to manage our renovation program. After all, 10 to 15% of the units available every month have to be renovated in order for us to implement our business model. And so, obviously, this means we have to manage our cash flows. But after a few months, you typically have enough capital to be able to make distributions to your investors. So on those value-added deals, you're typically seeing distributions within that first year, which is very exciting. Now, we have, exactly the idea of implementing this strategy is what we're seeking to do with our partners at Finsa and Upper. These assets are strategically located, and obviously they're located in, of course, one of the most populated cities in the United States, in Dallas and Houston. All of them have a projected 5-year hold, and typically our occupancy is averaging right around 90%. So these assets on average are typically providing our investors a return of somewhere right in the neighborhood of 24%, as well as a 2.5 equity multiple. So we see a great opportunity here to deploy capital into a stable market here in the United States. And we're excited about this partnership with Finsa and Upper to deploy capital into the United States.
So, okay, just to add, on top of that, some of the assets have tremendous development potential. I'm not saying that we're going to be developing. The plan A is to exit through cap rate compression. So we buy, we add value, we try to generate a nice big fat yield on cost around, I don't know, 8, 10, 11%. And then we try to find a buyer that is willing to discount that at, let's say, 5.5%. So it's like a bonus that it's duplicating value. So sorry. So that's plan A. But again, these guys have very good eyes. And to be honest, some pieces of land are 40 acres connected to a main avenue. So we believe in certain parts there may be potential to exit through, by conceptualizing, getting the right permits and selling just the incidence of the land to a third-party developer. So they offer several alternatives. But plan A, we believe is more than juicy. 44, 24, 25, 26% IRRs is what we have in the underwriting. We try to communicate less than that to our LATAM investors. But yeah, we believe we have good contents through you guys, of course.
Thank you. So, as we kind of wrap up this again, our goal here with our value add, with almost 7,500 units under management in terms of, actually property management and a very proven track record to destabilize distressed assets. We're able to essentially eradicate crime and create a community feel. And it's right after that stabilization period that we're able to refinance these assets and essentially exit. And we feel, positive, right? Not only do we make an impact to the community, but we're able to deliver, enhanced returns to our investors. So once again, we'd like to make the announcement formally here with our partners from Finsa and Upper Growth. Again, we think that this presents a very unique opportunity for investors in Latin America who are interested in deploying capital into the United States in various opportunities, not only into value-add investments, but also ground-up construction and misuse developments. And certainly, we are excited to partner with them on the opportunities that lie ahead. So thank you, Juan and Gonzalo. Any final words from your end before we start taking some questions?
Thank you, Sohail. Yeah, I would add in this slide that it's not only Finsa, it's Finsa Upper, the JV. We basically, what did in Chile, we did a feeder fund that will invest in the States through different assets. And the Chilean fund sent some of the amount of the money that it's going to be invested on the asset, but it's also as we said before, this is a platform, and there are other ways of going through Finsa Upper to the States from the other Latin American countries, and also from the States.
But just to be precise, Finsa is actually the one. A fund managed locally by Finsa in Chile is the one through which we made our first investment. And Juan, don't feel bad. You guys are much larger and interesting than us. So come on, it's the same.
We're only one team here.
Fantastic. Well, thank you so much. I appreciate it, gentlemen. So one of the questions that came in immediately was regarding, the United States real estate market. What do you see kind of the advantages in this market over other countries such as in Europe or in Canada? And, do you guys have experience in having invested in those markets before? Or could you kind of give us a little bit of, information on that?
So thanks for the question. I actually lived in Canada for a while, so I love that country, especially Toronto. And I kind of know the market. I have good friends there who run development platforms in that city and in the outskirts in Mississauga and ancillary and secondary places. And I believe it's a great market. Actually, Toronto is one of the largest metropolitan areas in North America. We like it. We believe it's super expensive presently, and it's very concentrated in 3-4 markets. Vancouver, for example, is extremely expensive. And then we believe that when the bad times come, you want to have a deep, profound market as the US. So, and I'm saying that being an Uruguayan, the smallest little country between two giants. And honestly, when we go down, the 3 countries that I know best, Brazil, Argentina, Uruguay, and Paraguay, we all go down. But when it recovers, trust me, normally the big guys recover much faster. So I believe there's value in that. And with respect to Europe, no, we haven't ever done anything there. But again, we talk to people who do invest there, and it's kind of fun because the going into secondary markets doesn't have a big prime. So what I hear is that normally you want to stick to Berlin, London, and Paris, because if you go to even Milan, you're going to get pretty much the same cap rates and much more risk. So life is too short. You can only do one thing. We made a big effort concentrating in the US, especially in Texas. So I think we're going to stick to that for a while.
Excellent. Thank you. And the next question was regarding your real estate portfolio, and how much of your real estate portfolio are you looking to invest in multifamily as compared to other asset classes?
Well, actually, the feeder fund that we did in Finsa is only for multifamily real estate. But the platform or the JV in the States is open to other subclasses in the real estate. So, for example, if we find something in developing, probably we will not put it on the Finsa fund or the Chilean fund, but we will do a different strategy with other investors, or for investors who are willing to take that risk, the risk of developing, for example. So I cannot tell you, and maybe Gonzalo can, what are the percentage that we will allocate to different subclasses, but I think for now we're focused on the value add real estate, and if we have opportunistic deals, we will probably look at them and see if there's a demand for those in our client base.
Yeah, I think we have a bias towards things we know, and we have done or participated in a way here in Latin America. So we're going to start with residential for rent. We want to incorporate single family for rent to the platform. Eventually, we will look definitely at logistics, but again, we are biased towards what we know. And just to be honest, I think that's what we're going to be doing for a while.
Sure. Well, thank you. Appreciate that. Moss, any questions from your end?
Well, I think one of the issues that I encounter whenever I speak to foreign or overseas investors is the issue of how do they keep track of their investments. I mean, if you're in another country, obviously it makes it that much more difficult to keep an eye on the investments that you make. And I think that's something that we can help with in terms of providing transparency and also more detail as to the day-to-day and week-to-week and month-to-month goings on of our, not only the entire real estate industry, but of course of the individual investments that are being made. And I think that's something that Market Space Capital can take a lot of pride in doing, because we do transparency quite well.
That's a great point. And I think for us, it's very important the govern that we do on our business in terms of how we manage, how we see, how we control, how we go there, even we're far away. So, for example, this year it's been almost impossible for the Chileans to go outside. The country has been on lockdown or with their borders closed. But for instance, this is a Latin American team, so Gonzalo and the Uruguayan team has been able to go to the States a couple of times to visit market space, and probably we will be doing that in a monthly or bi-monthly basis. So that's a way we want to focus on being close to the asset.
Absolutely. And, could you talk a little bit about the impacts of COVID and your countries and has it made it easier or harder for you to raise and deploy capital since the pandemic?
That's a very good question, Sahel. I think it's been Chile has done very good in world terms. I think nowadays we are the 6th country with a better vaccination process. We have 70% of the population with the 2 doses or the 2 shots, and in that sense, cases have dropped, and there's more mobility. People have gone back to the offices or back to work. Also, the service industry or the restaurants, the hotel are going back also. So in that sense, it's much better, but it's only in the last couple of months that we have seen better numbers. And regarding the process of raising and deploying capital, it has been tough in terms of there's a lot of interest and a lot of people willing to invest in the States. But people really like to be close to the asset. Some people maybe choose to maybe buy directly one apartment or a couple of apartments or houses in Florida or things like that, and then they realize that it's harder to do only a couple of apartments, but they have to go to that process, and And in terms of the institutionals, well, institutionals are more demanding on terms of track record, on seeing what we have done in the past, and so probably in a first fund they will look at us, and probably they will deploy or put capital in a second fund or in a second strategy, and they like to see uh, uh, the track record that we have or that we are constructing before investing.
Sure. Sure. Thank
Yeah,
you so
and
much.
in general, sorry, I believe investors are becoming more and more specific. The fund as a vehicle, as an idea, is getting less and less love, and it's been doing so for the last, I don't know, 10 years. If you check those like how to say it, reports that we get from private equity and real estate research groups and consultants, they normally ask the question, where do you want to invest, in what asset class, geography, etc., and through which type of vehicle. And funds as blank checks are less and less preferred. So I think we have to be ready to present direct investments to all sorts of investors, not only institutionals, but also retail. That's one thing. And I always say that for us, at least for Charlie, Fede, and I know Juan and Pablo and the FinSA team, but our FinSA upper team, we understand asset management not as managing funds, but rather bringing good ideas and doing the right thing when no one's looking. That's real asset management. So it's not about setting up funds per se. So I think we got to be open into other type of structures. Definitely.
Absolutely. No, and you're 100%. We've seen that from you guys in person. I mean, you always have taken your investors first, and I think that's obviously what's very important in these types of investments. So there are two final questions, and I think both of them very positive. First was, as a investor in LATAM, how can they get involved with a market-based capital and FinSA upper investment?
Well, they have to put in contact with us, with Gonzalo and me or the team. We can well, basically we have two ways. As we were telling before, this is a platform. We have a feeder fund in Chile. For Chileans, you can invest through the feeder fund, and for the other Latin American investors, we can go directly to the platform that we have in the States, and through there you can invest in market space.
Fantastic. And do you have a minimum investment that's required in your fund?
The Chilean fund has a minimum investment of $500,000
US dollars, right?
US, yeah.
But in general, we're
It's
super
50,000. Sorry, it's 50,000.
50.
50. No, but as a general concept, we are flexible, and it's always hard to define this is the right set of vehicles to go into a certain market. It's always on a case by case basis. So any investor that has a doubt, that wants to learn, or that even wants to explore which would be the best idea to put their dollars to work in the U.S. real estate market, happy to have a personalized approach and spend the time to go over that.
Absolutely. Well, gentlemen, thank you. Those are all our questions from the audience. I'd like to thank you for taking the time to join us today and talk about how to deploy capital responsibly into the United States real estate market. We appreciate you all. Dr. Oishi, I can take it over you to close this out.
Well, I mean, this was such a great webinar. I mean, time went by so fast. I wanted to thank our panelists, our very distinguished panelists, for their insights and their opinions, which are greatly appreciated. But I also wanted to thank our audience for their insightful questions. I think everybody involved in this webinar did a tremendous job, especially our representatives from FINZA and Upper Growth. Once again, we appreciate all of you for taking the time to join us. And on behalf of MarketSpace Capital, we thank you and encourage you to stay tuned for future webinars. Until then, we wish you a good night.